Hi, my name is Jared Mercado. I will be your presenter today for this case study assignment. I just wanted to say hi. I will turn the camera back to the presentation now as I get started with the presentation. Just want to thank you for seeing this today. I'll get straight into it. This is my case study assignment. I was asked to diversify a portfolio, minimize risk, and maximize return. These are the 8 price asset classes that I picked 5. I was given 4. The bond, oil, T-bill, and S&P 500 were given for the 24-month period that we are looking at from December 2019 to January 1st, 2018. I picked Amazon, Tesla, AT&T, Cayenne, Cameras, Deutsche Bank. These two, however, are ADRs, American Depository Receipts, which are foreign companies traded on the U.S. markets. We would then go over to this, which is I know it's a little small. I hope it's big when you blow it up. I will be submitting this presentation as well. So if you want to look at the numbers closely, please look at that presentation that I submit, or this Excel spreadsheet that I submit. These are the returns based on all these indexes, stocks, T-bills, bonds. This is the return without risk premium. So what does this mean? This is the first slide in our presentation tonight, which is alpha. Alpha is a measure of an investment performance. Alpha is a measure of an investment performance or excess return with respect to the benchmark. It is the risk-free rate in the benchmark in the alpha equation. What is the risk-free rate? The risk-free rate of the return is the interest rate on an investor can expect to earn on an investment that carries zero risk in practice. The risk-free rate is commonly considered to be equal to the interest paid on a 3-month government treasury bill. This is why we did not subtract the risk-free rate from each one of these stocks, bonds, oil, T-bills, and of course the overall index. That's why we kept it the same. This is why this says with return without risk premium, because we did not subtract the risk premium from them. These are both the equations for without risk premium adjustment. This is the first equation, and with risk premium adjustment that we'll get to earlier. And then this point we'll get to earlier as well. Let's go back to the return. So the average return, remember this section right here is return without risk premium adjustment. The average return for Amazon stock was about 1%, meaning that the average return for these 24 months, if you were to invest $1, 1% of $1 is 1 penny. So you will be getting 1 penny back on your investment. If you were to decide to invest $1. We're going to go back to all these returns. Unfortunately, these 2 American Depository Receipts gave me negative returns on the investments. All the other ones gave positive returns. We're going to go back to the sample standard deviation. The sample standard deviation measures the spread of a data distribution. It measures the typical distance between each data point and the mean. We're going to go back to this Excel spreadsheet. So the return on the Amazon stock, the standard deviation from the mean, which was the average return, was about 8%. That means that the standard deviation deviated 8% of the time from the average return, and so on and so forth. Here we see a 15% deviation from the average in terms of the stock price, and the adjusted, or because we looked at the adjusted close for 24 months, the adjusted price for each one of these from the average was about 15%, according to the standard deviation that we calculated. And we'll move on to the next one, which is the covariance. Let's see if I can make this a little bigger for the next time we come back to it. It's perfect. The covariance measures the total variation of 2 random variables from their respective values. Using covariance, we can only gauge the direction of the relationship, whether the variables tend to move in tandem or show an inverse relationship. However, it does not indicate the strength of the relationship nor the dependency between the variables. Positive correlation indicates that two variables tend to move in the same direction. Negative correlation reveals that two variables tend to move in the inverse direction. So we're going to go back. All these had significantly low covariances to the overall S&P 500 index. However, they were positive. They did stay the same. Or excuse me, not the same. They were positive and they didn't show any negative returns except when we got to the T-bill section right here. The T-bill section right here where it had a negative return, which means that for every time the S&P would go up, the T-bills would go down, and then vice versa. If the T-bill price went up, the S&P would often go down. The covariant, or we're gonna move on to the correlation, and then we're gonna compare the two to get a better grasp of both of them because they are very similar in a way. On the other hand, the correlation measures the strength of the relationship between values. Correlation is a scaled measure of the covariance. In other words, the correlation coefficient is always a pure value and not measured in any units. The correlation coefficient of 1 means that for every positive increase in one variable, there is a positive increase of a fixed proportion in the other. A correlation coefficient of -1, that for every positive increase in one value, there is a negative decrease or a fixed proportion in another. So we're going to go back to this Excel spreadsheet where we see this correlation, the correlation between. In order to diversify a portfolio properly, you want to find stocks, indexes that have no correlation with one another to, like I said, minimize risk, maximize return. And we compare the correlation to the S&P 500 from for each one of these, from the T-bills to the Amazon stock right here. And we found that as we go back down here, we found that 76% of the time that the Amazon stock went up has a correlation between the S&P going up, and then 15%, 60. You're not really looking at these as percents, sorry, but they're all positively correlated to the S&P 500 index. A percent is just an easier way of looking at it. However, do not look at these as percents. But we go over here and see a negative as well. That means that for every time the T-bill goes up, the S&P will go down, and vice versa. If the S&P goes up, the T-bill will go down. What are the differences between the two? So I've made a slide in here. When comparing the data samples from different proportions, covariance is used to determine how much two random variables vary together, whereas correlation is used to determine when a change in one value can result in a change in another. And the variance, which is the next topic, I just want to highlight this out. The variance helps determine the data spread size when comparing the mean value. As the variance gets bigger, the variation in the data values occur, and there may be a larger gap between one data value and another. If the data value are close together, the variance will be smaller. So if we go back, the variances are really small except for some of them where it has 0.02%, but most of them are pretty small in terms of the values varying from each other. That means that they did very closely with one another if the variation, the variance was smaller to each one of these companies. It was less than 1, which means that they all very closely with one another. There was no exact, there was no big spread of amount of numbers with the adjusted closes of any of the 24-month points that we looked at for any of the indexes, T-bills, crude oil stocks that we looked at. Next is beta. We're going to go back to the PowerPoint slide to look at that. Beta is a measure of the volatility or systematic risk of a security or portfolio compared to the market as a whole. A stock that swings more A stock that swings more than the market over time has a beta above 1. If the stock moves less than the market, the stock beta is less than 1. Higher beta stock are supposed to be riskier but provide higher return potential. Low beta stocks pose less risk but also lower returns. So we go back, we're gonna find that we have a 1.54 return on the Amazon stock, and then we have a 1.6 beta on the, sorry, not return, we have a 1.45 beta, 1.65 beta on the Deutsche Bank and Amazon. That means they performed above the market returns. Each one of these kind of didn't do too bad, just not as good. You look at the crude oil as well, they performed better than the market. However, these investments right here, the crude oil, Deutsche Bank, and Amazon are riskier. They should provide higher returns. They're not guaranteed higher returns, but they should provide higher returns. These are a little bit lower. They should also provide returns, but not as much as, of course, these right here that are more riskier than they are. I was then given the weighted average for each one of these, Amazon, Tesla. I was given the weighted average for all of these based on what I picked, and that, of course, the portfolio return and beta were really unacceptable for if I was to maximize return and minimize risk. So what I did was reallocate 30% to Tesla, Amazon, AT&T was 19%, kind of spread the rest out through because they weren't going to give me the maximized return that I want. But I did lower the risk as well when investing in these. I understood this was a little bit risky, but I did maximize the return on that one. So we will return back to this. I want to spread this out to show you this whole thing was the return with risk premium adjustments. So what does this mean? I will answer that right now as we go back to the PowerPoint. Slide presentation. Excuse me. What this means is that the risk-free rate of return is the interest rate an investor can expect to earn on the investment that carries a zero risk. What we did was we took this investment out of the whole portfolio and really looked at each one of these and how they performed with the risk premium adjustment. So what we did was we subtracted the T-bills from all these investments and see how they performed based on the risk level that they no longer had, since there was no longer a zero risk in practice. And we got several different returns, several different standard deviations. Beta did not change as much. It did go a little, it did show a little bit of difference, not a lot, but the adjusted returns for each one of these stocks were negative because of the risk premium that they are with the risk premium adjusted. They did show negative returns. The correlation was still about the same. The covariance was a little bit higher, I noticed, in the other sections. Vice versa. The correlation was a little higher. Covariance was a little lower. But we'll move on to this right here, which is the alpha risk adjusted. So what we did was, in the beginning, I know I'm going to go a little bit wide here. I hope you can still see it just a little bit. What we did here in the beginning was we did the return off of all these individual 24-month period on each one of these sections, return without risk premium. So what we did was down here, we took the average of all these and just really narrowed them down to, let's see if I can get this settled down, without risk premium adjustment, and then this was the width, this orange part right here. So we just took the average of all of them, put them together, and then what do these numbers mean right here? So we're gonna go back to the PowerPoint slide. And these numbers mean that a positive alpha indicates that the security is outperforming the market, while a negative alpha indicates the security generates returns at the same rate as the broader sector. So for every time the alpha went up, it outperformed the market. So we go back here, outperform the market. With risk premium adjustment, it didn't outperform it with the risk premium adjustment. It did without. This one didn't do anything with or without. It didn't outperform the market. This one outperformed. When it was without, this one outperformed it with, which I believe this was the crude oil and the corporate bonds. So there was a little vice versa there. And then the Sharpe ratio and tenor ratio. I hope I'm saying that right. They measured the Sharpe ratio, or the Sharpe ratio tried to measure, or is trying to measure the risk with respect to the standard deviation. The Sharpe ratio is positive when excess return is positive, which is when the investment return is greater than the risk-free rate. In the analysis results in a negative Sharpe ratio, it either means that the risk-free rate is greater than the portfolio return, or the portfolio return is expected to be negative. The portfolio return didn't expect to be negative. I believe it's this one right here. It means that the risk-free rate is greater than the portfolio return, which I believe that to be true. As we saw a whole negative line throughout the indexes, oil, bonds, stocks, throughout the whole thing, we saw a negative Sharpe ratio throughout that. The tenor ratio, you're trying to measure risk with respect to beta. It is a performance metric for determining how much excess return was generated from each unit of risk taken on by a portfolio. It is a risk-adjusted measurement of return based on the systematic risk. It indicates how much return on investments, such as a portfolio of stock, a mutual fund, or exchange trade fund, earned for the amount of risk of the investment assumed. A negative ratio indicates that the investment has performed worse than the risk-free instrument. And we're going to go back. Of course, all these were negative. They did not do well with none of them did well with the return with risk premium adjustment, unfortunately. And now we're going to go down here to the regression. It's a big thing, and I want to break it down as much as I can before running out of time. I know I'm a little over time. This is the Amazon oil, and then down here we have the corporate bonds. For question 18 of the case study, we were asked to show a regression line along with describe what the R squared meant. All these have regressions. All these are graphed already compared to, of course, the index, which is the S&P 500. These are all the returns with the risk premium adjustment right here. And we're going to go back to the PowerPoint presentation slide to see what this means. So the regression analysis is a reliable model of identifying which variables have impact on a topic of interest. The process of performing a regression allows you to confidently determine which factors matter most, which factors can be ignored, and how each factor influences each other. So this is what is showing us right here when we look at this graph and see all the plots. This is actually the mean, and these are the returns around the mean. If I'm understanding it correctly. And then the R squared is generally interpreted as a percent of a fund or security movement that can be explained by movements in a benchmark. Movements in a stock, bond, or commodity return can be predicted using the market return. The market return is able to explain the stock or bond commodity return. So 79, I believe this one was 79% of the time, the S&P 500 could estimate the return on the Amazon stock. I'm going to repeat that one more time. 79% of the time, the S&P return could estimate the return on the Amazon stock, if that makes sense. And then you have the risk associated with it. So that's 59%, sorry. Of the time, the S&P return can estimate the return on the Amazon stock. And this leaves the risk factor out, so it's 60%, right, if we round it up. So that means 40% is left for risk, so that where that risk is the remaining percent that other factors can affect the return on the Amazon stock versus the index. I hope I made that clear. I hope I didn't confuse you. This one's for oil. This one's for bonds. And for the last part, we were asked for the last question of the case study, we were asked to go through and do the whole process again, evaluating a different index. So I chose the FSTE 100 index, the Financial Times Index 100, or the Financial Times Stock Exchange 100 index is also called the FTSE 100 index. It shares the index of 100 companies by capital values listed on the London Stock Exchange with the highest market capitalization. It is registered by the UK company law. The index is maintained by the FTSE Group, a subsidiary of the London Stock Exchange Group. So we go back. Here is the same analysis. Different numbers, of course, in terms of the. I no longer have the S&P right here. I have the FST or the FTSE index. A lot of the numbers did change. The returns on the portfolios didn't. The risk, however, was lowered if you were to invest in this index versus the S&P 500. I did notice that. Everything was still low. When it comes to the return with risk premium adjustments in terms of the average return on each one of these compared to the with the risk associated as we subtracted each one from the asset prices. I did notice this right here on the alpha with or without the risk adjustment, or with or without the risk adjustment. I did notice that oil was actually up. If you notice that we went back over here to the S&P, oil was actually negative without, but it is actually positive when we go to the back to the. I thought that was very interesting, but then again, a lot of people invest in oil around the world, so it kind of made sense. None of the Sharpe ratios or Tanner ratios changed. They were all still negative in terms of the premium of investing in a particular security with stock or associated with risk, excuse me. We did do another regression for compared to the FTSE compared to the Amazon stock. So 26% of the time, the return on or the FTSE can determine the value or of the of Amazon stock 26% of the time, and then 70% of the time, if we round this to 70% of the time, there are other factors that can be affected by the return on Amazon stock. As we looked at this, the oil didn't really change. Like I said, a lot of people have invested in oil around the world as a commodity for these 24 months. It didn't really change from the S&P versus the FTSE. And we're going to go down here. We're going to look at the corporate bonds. It's very low compared to, almost 9%. It's almost nothing in the foreign London Stock Exchange. It's almost nothing compared to the S&P 500. That's what I found. I hope I explained everything thoroughly as best I could. I hope you enjoyed it. And thank you so much for a great semester, Professor. I appreciate your time. Thank you.